Hi everyone, I'm Andrew Marshall. I'm coming to you from Palm Springs. Happy New Year. In this video, I want to give you a quick update on the markets and explain why now is a better time than it has been in many years to be invested in a diversified portfolio. The reason it's a great time to be in a diversified portfolio and not sitting in cash anymore, not sitting in T-bills anymore, is that the economy is stronger than people expected. The stock market looks like it will do well. International stocks did well last year, and that should continue. A lot of experts predict that international stocks will do well over the next 10 years. Also, emerging market stocks look good. India is doing well, and then China will probably figure itself out and could be a good investment as well. So all the different stock markets are looking good. I would admit that the U.S. stock market is near an all-time high, which might be scary if you're going to invest cash in the stock market. But actually, if you look at a stock chart, the stock market makes all-time highs quite consistently, and there's really nothing to worry about if you're going to be a long-term investor. And really, we're all long-term investors because we're going to own stocks for the rest of our lives. So you shouldn't be afraid to invest when the stock market is at all-time high. Also, the reason a diversified portfolio is looking good right now is that the bond market is looking good in terms of investing in an aggregate bond fund, intermediate bond funds, or longer-term bond funds. The reason is that interest rates are at 5%, which gives the Federal Reserve room to reduce rates if needed when they want to stimulate the economy again. Experts are predicting that will happen 3 times in the 2024, first one in March. Obviously, experts can be wrong and often are. Like last year, they thought 85% of economists thought there would be a recession last year. It didn't happen. This year, they think there'll be rate cuts. That may not happen, of course, but if it does, then being invested in aggregate bond funds or at Vanguard, they call it the total bond market fund. Those kind of funds will be good investments because you'll be earning 4% interest per year, and then when the interest rates are cut, then the price of the bond funds will go up. So you'll see a good capital gain in your investment. So from a total return perspective, outlook for bonds looks really good. Not only does the stock market look good, bond market looks good. So if you have a diversified portfolio, you're sitting pretty really. If you're not there yet, you're not in a diversified portfolio, then you should start thinking about moving over from your cash, from your T-bills, and getting diversified. There are model portfolios online that you can use to figure out how you should be invested, or you can contact a fee-only financial advisor. They would help you out, or an hourly fee-only financial advisor if you are comfortable managing your own investments and don't want to pay someone to do that work for you. I have other videos on how to find an hourly financial advisor. You can check those out. And if you want to have other information about investing, financial planning, retirement, and investments, specific funds, then please consider subscribing to this channel, and I will see you again next week. Thank you.